Now, our chief equity strategist and economist, John Blank, is going to discuss with me real estate markets, both commercial and residential. John, what's the significance to looking into these markets now?
Terry, the issue you have here is we have affordability issues in housing, and we've got a commercial real estate price correction going on in commercial real estate. And the question you have is, does this spiral like '08 if into the lending crisis if it starts to tank downwards? And there are credible calls that the top will be in on the real estate boom of the last 18 years sometime in 2026. So obviously, talking about it in 2026 will be too late. So I thought properly, I think that now, May the 21st, 2025, is when we should be discussing whether these markets are overvalued or not.
Yeah, and while we're not trying to sound any alarm bells here, we are just trying to call this to everyone's attention so people can make informed choices and just so people can stay informed. And based on that, are you concerned about a real estate price collapse in either commercial or residential?
Terry, what we got to worry about right now is the 10-year Treasury, which tracks the fixed mortgage rates in the United States, is now moving up, and it passed 4.5% this morning. We're at 4.54%. And you typically you tack on 250 basis points on tap to get the 30-year fixed rate mortgage. So that's a 7% mortgage. If it goes up 100 basis points, Terry, then people who are wanting to buy a home using mortgage lending are going to have a harder time at these higher prices. So that can be the trigger for a big downgrade in the real estate values of residential. And in commercial, we've seen already a correction. So perhaps there's less of a concern now than you might think, and the real concern would shift to residential.
So, what's the status of the U.S. real estate financial system in general?
Well, Terry, quantitative easing was buying treasuries and mortgage-backed securities by the Fed for almost a decade, and what it did is it stored all these mortgage backs on the Fed's balance sheet, and that drove up private equity, household equity of people who own houses to extreme levels. So there's a ton of equity, at least in on books. Not maybe if you sell, it's not really there. We'll find out, but it certainly is a massive amount of wealth on people's balance sheets.
What's the story with bank loan standards?
Well, they're holding up, Terry. They're still pretty. They're not getting tighter. That's a non-interest issue. But if we do get more of a slowdown in the U.S. economy, then that would be the other shoe to drop, which would be lending standards would tighten in front of trying to limit loan lossing to at-risk people in the job market or companies that are at risk. So that's another thing to watch out for is lending standards rising, on top of interest rates rising.
So, what real estate trends should we be concerned with at this point then?
Well, Terry, we've got to be concerned about the two things we've talked about. We've got to be concerned about where the 10-year Treasury heads if it gets over 5%, and we got to talk about any news that is relevant, and studied well that says that lending standards are tightening for the real estate markets. And we get enough of that, then you should start to be concerned.
Are you concerned about a housing crisis going forward? If so, what might those triggers be?
Yeah, like I said, Terry, this is my concern. I personally think, up top in 2026, the three major groups, the National Association of Real Estate, Urban Institute, these other groups, are still calling for, 2 to 3, 4% rises in real estate prices for the next 18 months. But you got to look out to 2026 and say, all these underlying factors could start to ripple into pullbacks in those real estate prices, and that could change the underlying lending standards too.
Against this backdrop, then, what are your current economic projections going forward?
Jerry, I've taken down my GDP growth rate for 2025 from 2.8 to 1.8, and 1.8 is still, good in Europe, I guess you could say, but it's not good for the United States. And when you got a stock market at 21 and record high prices in real estate, it's not, yet concerning to the job market. But if we start to see job losses from that slower growth, that's when you should be concerned.
Will the Moody's cutting U.S. government long-term credit rating have any impact, any material impact on economic growth going forward?
Well, Terry, we got to watch out what's, I think the answer is they telegraphed they were going to do it for many years. So I think it was in hand. They just waited to see what the fiscal budget was going to come out before they finalized it. But we're still at a high rated thing, and then it's the cleanest dirty shirt in the wardrobe thing, and there just simply isn't enough other places that are deep and liquid like the U.S. dollar and the Treasury market. So I think we carry on in the direction we are, as the world reserve currency and the default safe haven, particularly with what's going on in the Japanese markets with the JGBs spiking to record multi-year highs. You still gotta think the U.S. is the place to be.
Strong buy stocks on your radar currently include Amphenol, Carvana, and Barclays.
Yeah, Amphenol is a stock I've liked for a long time. It is in the large cap trigger. I run for Zacks. It's a number one ranked stock again. Now we're at $86 a share after a huge rally off the lows. Not during the Liberation Day. It got down to 60. Now it's back up to 86. And we've got a target price of $100 a share, Terry. You got to love this stock. I only will point out the concern I always have about tech stocks in a hot area like this, which is a top 1% industry, electronics connectors, is the P ratio is 32.4. So it is a value score of D.
And Carvana.
Carvana is this amazing story of a used car company that, spiked high to $350 a share during the COVID period and then almost went bankrupt in 2023. Now it's all the way back up to $302 a share. Just phenomenal story of a rebound here. Probably the best way that made a ton of money in the last 2 or 3 years was Carvana. I certainly wouldn't be a buyer at this stock, even though it is a number 2 rank, because again, the value score is D and the PE ratio is 70, Terry.
Barclays.
Yeah, Barclays, of course. This is got 2 divisions, Barclays UK and Barclays International. It's a very, very old English bank, international lending. And you could have bought it for $8 a share in early 2024. We're looking at a price of $18 a share now, Terry. This thing went from 13 to 18 in this Liberation Day. So here's another name that's, huge buying of foreign banks because they posted good earnings. And it's a top 7% industry. The P ratio is 8. And you get a dividend yield of 3.1%. So here's a name that, 2-3 years ago during the AI boom in the United States, you could have bought it, $6-8 a share. But no longer, man, the momentum is on for Barclays.
Our chief equity strategist and economist, John Blank, on real estate and the economy. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.